we clearly have seen a continued rise in cases, and that's clearly a key concern. We've also seen some loss of momentum across Europe. So following very strong data between May and July, we've clearly slowed down in August and September, and we've also nudged down our forecast for Q3 GDP. But we remain pretty optimistic beyond that. One reason is that fatality rates have remained much lower than earlier in the year. And so we think the hurdle for a return to nationwide lockdowns that would weigh a lot on activity is pretty high. We also see a very supportive macro backdrop with more fiscal spending coming that supports the recovery. And finally, the global environment, we think, is improving with better data out of the US and out of China. So despite these risks that we need to monitor very closely, we actually remain quite constructive on the European recovery here.
And looking at consensus and where economists are in terms of the European recovery, we have seen economists revising higher their forecast for this year, but in a lot of cases revising down the rebound that they're expecting to see in subsequent quarters. Do you think we're going to see more of that come through in the coming weeks?
Yeah, I think that's feasible. I think that's natural in response to what we've seen. I think we've generally seen that the rebound in Q3 has turned out to be larger than people initially anticipated. But that also means that there's a bit less catch up for growth to do in 21. And of course, as we just said, the risk of new restrictions, some of the loss in momentum, some new risks that have arisen is also likely to weigh a little bit on growth in Q4 and maybe in Q1 as well. But as I said, despite that, we actually feel quite constructive here as far as the European growth outlook goes, and also think, as you said earlier, that the euro will continue to rise from here.
I want to come on to the euro in just a moment, but connecting your view to what we're seeing in markets this morning, it's a pretty brutal sell-off underway here in Europe. And it feels as though in recent weeks there had been some positive momentum building behind this Europe versus the U.S. trade. It looked as though the virus was more under control in Europe and we were on stronger footing. Of course, the U.S. has the election to contend with coming up, but it feels like that trade is unwinding a little bit. So how would you position Europe and the potential recovery here versus other parts of the developed world?
Yeah, I think that's right. Europe initially came out of the deep downturn very strongly. Very strong data between May and July, whereas the US took a bit of a pause in the recovery in July as cases there spiked. I think we have now seen a little bit of a turn here. The US data has rebounded very strongly in August, as we just said. There has been a loss of momentum in the European data in August, but we think Europe is well placed to continue to recover from here. We have a very supportive policy backdrop, both from the ECB, where we expect more stimulus, and also on the fiscal side, where France and Germany have already announced quite a bit of stimulus for next year. And we also expect more to come in Italy and Spain on the back of the recovery fund. So the shifting around in the recovery is important, but we still remain constructive of, in terms of where Europe is headed here.
Let's switch on to the euro. You mentioned that the euro appreciation you don't think is going to weigh too heavily on the European economy. We were all watching Madame Lagarde very, very closely at the last ECB meeting as to whether the ECB would in fact be targeting the exchange rate. And she seems to have put those concerns to rest. Is this a concern that investors should just be putting to one side for the moment, the fact that we are seeing euro strength here?
Well, I think the stronger euro will weigh on the recovery to some extent. I think that's inevitable. But I think what's important, though, is the context of the euro appreciation. And in our view, the stronger euro predominantly reflects an improved outlook, both in Europe and globally compared to where we were a few months ago. And so in that sense, the stronger euro is a sign of good things rather than a malign appreciation that the ECB might want to lean against with rate cuts. So we think that's why there's only been limited concern around the strength of the euro. And that's also why we think the hurdle for rate cuts by the ECB here is actually pretty high. We think they will provide more stimulus, but we think that's more likely to come by a more QE rather than a rate cut.